to chew on there. Our next guest has navigated such questions for a long time. David Dodge is the former governor of the Bank of Canada. He is currently a senior advisor at Bennett Jones, and he joins us from Ottawa. David, nice to have you as always.
Morning, John.
Let's start with the housing story. Obviously, it's a concern for so many Canadians right now, the higher cost of living. If you have a mortgage, obviously rising mortgage costs as well. How concerned are you about the housing market?
Well, when we continue to have rather strong labor markets, when we continue to have excess demand generally in the economy, and continue to import 1 million additional people every year, it's not very surprising that there's excess demand for housing, and that's not going to go away very quickly at all.
And so in terms of the labor market itself, there are a lot of dynamics there. We do have a jobs report coming this Friday. How long do you anticipate that the employment picture can show signs of resiliency if that issue of higher interest rates further complicates the economic road ahead, and if companies are making decisions on what they want their workforces to look like?
Demand has remained stronger both in Canada and the United States than we had anticipated, and much of the correction in the labor market is going to come first from decline in vacancies rather than from an increase in unemployment. So as we look forward to the second half of this year and into the first half of next year, what I think is most likely is that we have growth continuing, slow in the sense of in the order of 1% or something like that, but nevertheless growth continuing. And it makes it very hard to achieve disinflation when we continue to have growth and when we continue to have, by historical standards, pretty robust labor markets.
What would be your own anticipation on that subject of inflation, which everyone has watched, and obviously central banks are trying to tackle the inflation issue? Can inflation get back to those target levels that so many central banks have been looking to achieve?
The answer to that question, you said can. Yes, it can. What it will require is continued rather elevated interest rates right through 24, right into 2025, to continue this slow but nevertheless ongoing disinflation process. And that process gets stickier, if you will, as we try to move down from 3 to 2. So it's going to be a long period of what would be considered elevated interest rates in terms of what we experienced in the pre-COVID period.
So for anybody who's been wondering after this aggressive rate hike cycle, whether or not we're nearing the end or even at some point possibly in line for a little bit of a pullback in interest rates, when you talk about elevated interest rates through 2024 and into 2025, does that mean these current interest rate levels that we're seeing, you think will hold for upwards of 1 to 2 years here?
Well, the precise number I hesitate to guess at, but what I would say is that I think it's very likely we're going to have an interest rate as we get into 2025, having gone right through 2024. I think we're still going to have interest rates in the order of 4%, the policy rate at the Bank of Canada, in the order of 4% even then. And that's in part because this cycle has been longer and has not had the really serious crunch that some people had expected, number one. But number two, and I think most importantly, because we are beginning the second quarter of this 21st century, and that second quarter of the 21st century is going to be a period when naturally interest rates are going to be higher because we will not have the degree of excess. I'm sorry?
Oh, sorry. Continue, David.
Uh, uh, because we will not have the degree of excess supply that we experienced all the period from the 2008 great financial crisis right through the beginning of COVID. We are going to be in a period where there's going to be a degree of excess demand in the world, coming from lower savings as the baby boomers age, number one, and number two, coming from increased investment as we try to deal with climate change and technological change.
So those are all helpful context pieces, whether it's Canada, the U.S., or other economies as well, for those who have been trying to figure out why we haven't seen clearer signs of a real contraction or a recession, or however you want to characterize it. You talked about slower growth. For those who are curious about whether we are moving into a recessionary period, whether ultimately Canada's economy is going to turn lower, it sounds like you're painting a picture where rates can stay elevated. There's enough supports in the jobs market that these ideas of, I mean, I don't know what language we want to pick here, but people often talk about a soft landing. Do you see that as a reasonable scenario at this point?
I think it is. I think it's the base scenario. If you're having a distribution of expectations, I would say that indeed is now the base scenario. One would not have said that a year ago or 18 months ago.